Okay, welcome to Accounting 503. This is modules 11 and 12, tracking chapters 11 and 12. Be sure and look at the module 11-12 Blackboard post because I definitely do not want you reading all of chapter 11. Don't get me wrong, there's no harm if you do, other than you've wasted a little bit of your time as far as this class is concerned. All of chapter 12 though, so going to have to suck it up on that one. Okay, let's get started. So the learning objectives for this module, we're going to talk about the typical accounting period that's available to taxpayers. We're going to really just reinforce cash versus accrual. We saw this in previous chapters, and I blew that open for you. This chapter covers it again, so hopefully most of that is a repeat, so I'm not going to spend a lot of time in the videos on it. We'll do installment sales. We'll talk about imputed interest. And then in the chapter 12 portion of the video, we'll go over those learning objectives. Okay. So accounting periods, a period is almost always a year, which is really 12 months for tax purposes. And individuals, S-corps, and personal service corporations are almost always on a calendar year end. So individuals are on a calendar year end. That's why virtually all of us file our tax returns by April 15th. Flow-throughs are generally required to adopt the fiscal year end of the partner that has a majority ownership. In situations where there's no majority, you view those who have a greater than 5% interest in the flow-through, and then otherwise the least aggregate deferral. And I am not covering that because that should have been part of your business tax course, to the extent you are a accounting major. Corporations have the flexibility to choose whatever fiscal year end they want, and they can also choose what's known as a 52 or 53 week year, which is that the year always ends on a certain day of the week. So you'll see something, for example, like a theme park would choose a 52, 53 week year because they always want to make sure they get the same number of weekends inside every year because a lot of their business is derived on a weekend, just as an example. Okay, so from an accounting methods perspective, virtually all individuals are on the cash method. However, if they report a Schedule C, if they have a sole proprietorship, or any other type of business, so a partnership or some other form of flow-through, those can be on the accrual basis or the cash basis as need be. So again, I'm not going to dig in on these. You can refer back to our previous coverage of these topics. But since we focus on individuals in this course, we focus on cash basis, which includes items like constructive receipt, deduction when paid, and the so-called 12-month rule. Okay, so that pushes us straight into installment sales. So, an installment sale is related to a situation in which the proceeds from a sale are collected in years subsequent to the year of the sale. So in this case, what would happen is, let's say I sell you something for $1 million, but I get $100,000 a year for 10 years. Well, to tax you on the entire gain in the year of sale isn't reflective of ability to pay. And so this installment sale treatment affords the taxpayer the opportunity to also spread the gain from that sale out over the collection period rather than have it all be taxed in the year of the sale. And clearly this is better than paying all the taxes up front generally because you will not have received all the monies that are contributing to the gain yet. So this installment sale treatment only applies to gains. The idea that you defer your losses is a little bit crazy anyway. And at least one payment must be received after the close of the taxable year in which the sale occurs, or else there are no installments. And you may not apply the installment sale treatment to inventory or marketable securities. Okay. So when we think about the way we're going to calculate the installment sale, what we need to remind ourselves is this doesn't affect the amount, but simply the timing of when that gain is recognized. So we need a method by which we can space out the recognition of gain so that it's commensurate with the amount of proceeds, the cash proceeds you're receiving. So the first thing we do is we calculate the income. And the income you're going to recognize, so the amount of gain you recognize, is the amount of payment you receive multiplied by the gross profit ratio. So the amount of payment you receive, that's pretty straightforward. What did you get paid this year? So it's really all about the gross profit ratio. And the gross profit ratio represents the gross profit on the sale. So think of that as the gain on the sale divided by the total contract price. And think of the total contract price as being the amount that you are going to receive as a taxpayer. So gross profit is the amount realized less the adjusted basis, right? So that is our gain amount. So let's say Jones owns a retail store, the building, and the building has a basis of $1.5 million. And in 2018, Jones agrees to sell the store to Smith. And Smith is going to pay $1 million in 2019, another $1 million in 2020, and another $1 million in 2021. And we can assume that this qualifies for the installment sale treatment, but it does because we can see that the payments are going to be received after the end of the year of sale. So the first thing we would do is calculate the total contract price. So the total contract price is 3 payments of $1 million or $3 million. The gross profit is the amount realized, which is that total contract price minus the adjusted basis of $1.5 million. So the realized gain is $1.5 million. And therefore the gross profit percentage is simply the gross profit divided by the total contract price, or 50%. 1.5 million divided by 3 million. So what this means is that for every payment that Jones receives, 50% of that payment is considered to be recognized gain. So when they receive no payments in 2018, even though that's the year of the sale, there's no recognition of income. In 2019, when they receive $1 million payment, they need to recognize 50% of that amount as gain, so $500,000 is the gain. Same in 2020, same in 2021. So as I said, the installment sale method doesn't affect the amount of the recognized gain. We knew that the recognized gain needed to be $1.5 million. It's just now spaced out over 19, 20, and 21. So one little blurb that is important, that's not part of these examples, but I think is in the chapter, is that to the extent you have depreciation recapture, that amount is required to be recognized in the year of sale, even if no cash is received. The problem is we haven't done depreciation recapture yet, so that's chapter 13. So we're going to avoid depreciation recapture with respect to installment sales, at least for the time being. But if it pops up in your homework, now you know. Okay, so our next topic is something called imputed interest. And imputed interest is really just a concept. And I think the concept is fairly straightforward, but it does take a while to wrap your head around it. So let's assume Wimpy needs a loan. And so Wimpy goes to Bank One, and Bank One says, okay, Wimpy, we'll loan you $100,000, and the interest rate is 6.5%. And then Wimpy goes down to Bank Two, and they say, we'll give you a $100,000 loan, and the interest rate is 0%. So generally, we would, as interesting as I'm sitting here, there was just an earthquake, which is pretty cool. That doesn't happen very often. This is a very quick one. Anyway, so obviously, no one really is in the interest of loaning people money with no interest charge. So what that means is Wimpy is definitely better off under Loan 2 because he's not being charged for the use of someone else's money. That's imputed interest. What we have to do is say, well, look, it must be that a portion of what that Bank 2 is going to collect from Wimpy actually is interest. And we have to impute that amount because it's not stated as part of the loan. And you get imputed interest when you loan money that is below market rate. Now, market rate is in the eye of the beholder. So what happens is the IRS publishes a number of tables that include what they call the applicable federal rate. If the stated rate is below the applicable federal rate that would apply to a loan like that, then the taxpayer must impute interest. So imputed interest does not apply to certain transactions, and this is largely because the IRS views this as, look, these are so small, they're nuisance, right? So we're not going to bother. So if it's a sale of property for $3,000 or less, there's no imputed interest. If the terms of the loan are 6 months or less, then there's no imputation of interest. If it's a gift loan, so if this is a loan of $10,000 or less between two people, unless it's used to purchase income-producing property, there's no imputed interest. And lastly, loans from a business to its owner or employees that are below market, as long as they're $10,000 or less, there's no reason to impute interest on those loans. Okay, that brings us to the end of Chapter 11. We will move on now to Chapter 12, but as part of the same video. All right, welcome to the Chapter 12 portion of Module 11-12. So the learning objectives here are simple. We're going to learn how to compute the recognized gain under a like-kind exchange, an involuntary conversion, and the sale of a primary residence. What could be more straightforward? 3 simple things, right? So this should all be repeat. Amount realized is the amount realized by a taxpayer from the sale or other disposition of an asset, is everything of value received from the buyer, less any selling costs. So taxpayers typically receive cash when they sell property, but they may also receive marketable securities, notes receivable, similar assets, or any combination of those items as payment. So amount realized is the cash received plus the fair market value of any other property received, plus any buyer's assumption of the seller's liabilities, less the seller's expenses. So that's amount realized. And again, all this is repeat. Adjusted basis generally is the original basis reduced by depreciation or other types of cost recovery. So we think of this as adjusted basis is cost basis minus cost recovery deductions. And of course, your realized gain or loss on the sale, exchange, or disposition of an asset is the amount realized minus the adjusted basis. And we've learned thus far that most gains and losses that are realized are also recognized. But we have had a few examples of some that are not. For example, wash sales, losses on a wash sale. Those are not recognized. How about losses to related parties? Not recognized. Or personal losses? Not recognized. So we're not in brand new territory. We're just looking at some new items within the same territory. Because this chapter deals with 3 non-recognition provisions. And I would actually describe 2 of them as being deferral provisions, and 1 is an exclusion, but we're not going to split hairs about that. So again, they are like-kind exchanges, involuntary conversions, and sale of a principal residence. Okay, so let's start with a little story. And this story involves a guy named Lawrence. So Lawrence purchased land for his investment. So he chose it as an investment in the town of Desert Shores, which was up against the Salton Sea in 1954. And he paid $20,000 for a 1-acre lot. So Duke, on the other hand, purchased land in Desert Shores in 2014. So a solid, 60 years later? 70 years later. Wow, long time later. In any event, actually it's 60. He paid $400 for a 1-acre lot. And now neither Duke nor Lawrence have developed their lots. They bought it only for investment. Okay, so you can see there is a giant price difference here. So the reason is in 1954, this is what the Salton Sea looked like. So it was useful, people boated on it, it was a bit of a vacationer's paradise. However, more recently, the Salton Sea looks like this. So when Lawrence bought it, it was lovely. When Duke bought it, it was a bit of a wasteland. Okay, so Lawrence and Duke own this property, and it's near the Salton Sea. And so I've brought up a map of Desert Shores. And you can see the properties are right across the street from each other on Honolulu Lane. So in all other ways, they are similar. And if I could expand the map and zoom in, you would see that the canals that support each of their homes from behind there's no water in them at all. Okay. So the estimated value of each lot currently is exactly $400. So Lawrence proposes, I have an idea, Duke. Why don't you and I exchange properties? Because an exchange is a sale, exchange, or disposition, and therefore triggers realization and usually recognition of gain or loss. So if we look at Duke, let's start on the right and look at Duke. He'd receive $400. That'd be the fair market value of the lot he receives. His adjusted basis is $400 in the lot, and he's break even. So to Duke, this is nothing. It's as if nothing's happened. Larry, on the other hand, receives $400 worth of property, but his adjusted basis, because he bought it back in 1954, is $20,000, and he has a realized loss of $19,600. So if Larry were able to capture that loss, to recognize that loss, he'd be able to book a $19,600 tax loss, but he would be in basically the exact same economic position as he was to start, right? If we look back, he would own the property across the street instead of the property he owns now. So the tax law simply isn't comfortable with the idea of being able to capture tax losses when no economic loss has taken place. So recall the wash sale rules basically function the same way. It said, look, if you acquired substantially identical property, then you couldn't recognize your wash sale loss. In this case, Section 1031 says no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So there are some key terms in Section 1031, and 1031 was updated in late 2017 with the Tax Cuts and Jobs Act. So it's important to pay attention to some of these terms. The first is real property. You cannot do a like-kind exchange any longer on anything but real property. So real estate, buildings, land, etc. The property must be held for business or investment. So if you are the taxpayer, the property you're giving up must have been held for business or investment, and the property you're receiving you must also use for business or investment. However, your counterparty doesn't necessarily have to have done so. That would negate their ability to have like-kind exchange treatment, but it doesn't yours. The property must be like-kind, and we'll get into that. And the rule is they shall, right? No gain or loss shall be recognized, which means you do not have a choice. This is a 1031 it applies to like-kind transactions. No gain or loss shall be recognized. All right, so what does like-kind mean? Well, pretty much any real property for any real property is considered like-kind. So, for example, a warehouse for an office building, like-kind. An apartment building for a bowling alley, you bet, still like-kind. However, one of the restrictions is, for 1031 to apply, the property may not be located outside the United States. So let me ask you, what do you guys think the odds are of finding two real property investments with the exact same fair market value? So for example, in our Lawrence and Duke example, they had the same fair market value. But as you can imagine, since property and land and buildings are so distinct, the idea that you would always be able to match up exactly the fair market values of those two properties is pretty low. So Todd's apartment building is worth $140,000. Betty's bowling alley is worth $130,000. If they were to exchange these, then obviously Betty would end up getting something worth $140,000. Todd would only get something worth $130,000. In all like-kind exchanges, there's an underlying presumption that the properties being exchanged are of equal value. Now, that doesn't mean equal basis. It simply means equal value. Because if they're not, the idea is there must be something hinky going on, right? Why would I exchange something of value for something with a different value, unless, of course, that value was greater, right? In which case, then your counterparty is the one who's breaking the rules. So Todd takes the bowling alley, but he's also going to insist on $10,000 of Betty's cash or some other form of property. And so now the two items being exchanged are even. They are of equal fair market value, right? Todd gives up something worth $140. He gets something worth $130 plus $10,000 of cash, so a total of $140. The problem is now it's no longer like kind because we've injected cash into the situation. So when we have a like kind exchange that involves something known as boot, which is any non-like kind property, then that changes the rules. So boot can be cash, cars, personal property of any kind, chickens, or anything else that isn't the like kind real property. However, the receiving boot does not destroy non-recognition. Instead, you are required to recognize any of the realized gain to the extent of any boot received. And again, some key terms in that definition. First off, you recognize any realized gain. This does not apply to losses. Receiving boot does not trigger loss recognition. To the extent of boot received. So what that means is you compare the realized gain and the boot amount, and you only recognize the lesser of those two. And then lastly, it's boot received. It doesn't relate to boot being paid. Okay, so SpongeBob has a pineapple-shaped rental condo. His basis is $25,000, and the fair market value of that condo is $200,000. Patrick owns a rock-shaped rental condo in Tahoe. It's worth $150,000, and Patrick's basis is $100,000. And they decide they want to do an exchange. Well, it's real property. It's like kind, right? Because real property for real property is like kind. It doesn't matter that one's on the beach and one's in the mountains. So, of course, the fair market value of these two items do not agree. SpongeBob's condo is worth $200,000. Patrick's is only worth $150,000. So they decide that SpongeBob's going to get the Tahoe condo and $50,000 in cash. Of course, Patrick just gets the pineapple-shaped condo. So since it's a like-kind exchange, SpongeBob wrongly assumes he'll pay no tax. But of course, in the meantime, he walks away with $50,000 in his pocket, which of course he's going to choose to spend on a bag of shrooms so he can go to Vegas. All right, let's look at what this transaction looks like. So in the top box, we see what is happening with SpongeBob. So SpongeBob is giving up his Bikini Bottom condo worth $200,000. In exchange, he's receiving a Tahoe condo worth $150,000 and $50,000 of cash. Patrick is simply the mirror reflection of that. He's giving up the condo and the cash, and he's getting the Bikini Bottom condo worth $200,000. Okay, let's focus on SpongeBob for a second. So we need to recognize the realized gain to the extent of any boot received. So let's look at SpongeBob's exchange. First is, what's the amount realized? Well, he gets a condo worth $150,000 and $50,000 in cash. So his amount realized is $200,000. Recall his adjusted basis was $25,000. That was given. Therefore, he has a realized gain of $175,000. He needs to recognize that realized gain to the extent of any boot he received. Recall that Patrick pays him, so he receives $50,000 in boot. As a result, he'll recognize $50,000 of gain, but the remaining $125,000 of gain is deferred until at some point either SpongeBob dies or he ultimately does sell the new condo that he's received. When we look at Patrick's transaction, his amount realized is $200,000. So that's the value of the condo he's receiving from SpongeBob. His basis is 150. But recall that that basis doesn't match up with what we said. We said that Patrick's basis in his condo was 100,000. So why is it I'm reflecting 150 here? Well, recall Patrick is giving up an additional 50,000 in cash. So the basis of what he's exchanging is the 100,000 in the condo and another 50,000 in cash. As a result, his realized gain is 50,000. Now Patrick pays boot, but he does not receive any boot. So as a result, he has no gain recognized and all of his gain is deferred. So we should note that if in either of these counterparties someone assumes the debt of the other person, that is in fact considered boot and therefore would trigger recognition of gain. Okay, so the next thing we need to measure, knowing that these are held for investment or for business purposes, we need to measure the adjusted basis in this new property after the exchange. So the general rule is something called carryover basis, which is the basis of whatever you give up is the basis of the new item that you received. It just carries over to that new item. The problem is we need to adjust for boot. So you would either adjust the original basis plus any gain recognized less any boot received, or it would be the original basis plus any boot paid. All right, so if we do this for SpongeBob on the left, his old basis was 25,000. His gain recognized is 50,000. The boot he receives is 50,000, and his new basis meets the general rule for carryover basis of 25,000. Patrick, on the other hand, recalled his old basis in the condo is 100,000. He's given boot of 50,000, so his new basis is 150,000. There is an alternative formula for determining the basis in the new property, and that's the basis in the like-kind property equals the fair market value of the like-kind property received minus any deferred gain plus any deferred loss. So if we do basis this way, we'd say, okay, well, let's think about what SpongeBob gets. He gets a condo worth 150. The gain that's deferred for SpongeBob was 125. So the 150 minus the 125 gives him a basis of 25,000, or the same carryover basis we calculated under the previous method. Same for Patrick. He gets the condo worth 200,000. His gain deferred is 50,000. As a result, his basis in his new condo in Bikini Bottom is 150,000. To the extent you have carryover basis, you also tack on the holding period. So let's say SpongeBob had owned the pineapple-shaped condo for 3 years. And then he does this exchange. So now he owns this rock in Tahoe. However, the holding period that he had for his Bikini Bottom condo tacks on to the holding period that he has in his rock. So on day one, he already has a 3-year holding period. Okay, let's do a whole bunch of examples of like-kind exchanges, because my experience is this is the best way to make sure you understand what's going on. So let's start with the top row. So we've got the basis of the land being exchanged is 20,000. There's no boot received. There's no boot paid. But you're receiving 85,000 of land. Okay, so if we were to calculate the realized gain or loss, we'd say, well, what is the amount realized? Well, that's everything you receive. So in this case, 85,000 minus your adjusted basis of 20,000. So your realized gain is 65,000. I apologize. So that would be 65,000. Your recognized gain is 0. All of your gain, which should be 65,000, is deferred. Therefore, the basis you have in the land you received is simply carryover basis, or 20,000. All right, let's go to the second line. where the basis of the land being exchanged is 45. You're now going to receive boot of 14,000, and you're also going to receive land. So these are all like-kind exchanges worth 70,000. So let's think about what is your realized gain or loss. That's your amount realized is the 70 plus the 14. That's 84. Your adjusted basis is 45. That yields a realized gain of 39,000. How much of that gain do you recognize? Well, you're going to recognize your realized gain to the extent of boot received. So you've received 14,000. As a result, you'll recognize 14,000. The remaining 25,000 of your gain is deferred. And so if we were to calculate your basis in the land received, there'd actually be two ways of doing this. You could use the long method and say, oh, well, that's the carryover basis of 45 plus the amount of gain recognized, or 14, minus boot received of 14. And that leaves you the same carryover basis that you had, 45,000. The alternative would be to say, well, let's see, now I'm sitting on a piece of land worth 70,000. If I were to sell it for that price immediately, I would need to recognize my deferred gain of 25,000. The only way that would be true is if I established that the basis in that land was 45. Those numbers match up, and we are ready to move on to the third row. So in this case, again, same 45, but this time I'm paying boot of 14,000. So in this case, the amount received is 70,000. The basis of what I'm giving up is 45 plus 14, which in my mind, that's 59. So 70 minus 59 is 11,000 of realized gain. How much of that do I recognize? Well, I recognize gain to the extent of boot received. I received no boot, therefore there's no gain recognized. All of that realized gain is deferred. That would allow me to calculate my basis in my new land received as 59,000. Think of that as either the 45 plus the 14 or the 70 minus the 11. Okay, now the fourth row, basis of land is 65,000. We're back to getting boot of 10. We have, and we're also receiving land worth 60,000. So let's think about calculating the realized gain. So what am I receiving? 10,000 of boot, 60,000 of land. That's 70,000 minus my adjusted basis of 65,000, which is 5,000. How much of that do I recognize? Well, I recognize my realized gain to the extent of the boot received. So I only recognize the smaller of those two, or 5,000. Therefore, none of it is deferred, and I need to calculate my basis, and it's probably going to be 60,000, which is either the 65 plus 5 minus 10, or the 60,000 minus any deferred gain, which is 0, therefore 60,000. All right, let's skip down to the 1, 2, 3, 4, 5, 6th row. In this case, I've paid boot instead of received boot. So let's think about calculating your realized gain or loss. What do you get? You get something worth 60,000. What are you giving up? Well, you're actually giving up 65,000 in basis plus cash of 10,000, or 75. Therefore, you actually have a loss of 15,000. How much of that loss do you recognize? You recognize none of it. So remember, you only recognize gain to the extent of boot received. So not only do we not have gain, we don't have any boot received. So as a result, no gain or loss is recognized. The entire 15 is deferred. When we calculate our basis in the new land received, we would say, okay, well, that seems pretty straightforward. Let's use the fair market value method. Right? What does my basis need to be if I turn around and sell this for 60,000 and I need to recognize a $15,000 loss? Well, that's simply 75,000, which is the same as my carryover basis plus boot paid of 10,000. All right, so our last row has 65,000 basis in land exchanged, 5,000 boot received, and 50,000 is the fair market value. of what you're receiving. So this is pretty straightforward. Amount realized, 50 plus 5 or 55. Adjusted basis, 65. $10,000 loss. How much of that loss do we recognize? None. How much of that loss is deferred? All of it. What is my basis in the land received? Well, let's see. I get 65 plus 0 minus 5. Sounds like I'm going to be at 60. And that's exactly what I'm at. So the other way of thinking of that is if I have fair market value of land of 50,000, if I were to sell it for 50,000, how would I recognize a loss of 10? Well, its basis would need to be 60. Okay. So let's change gears and talk about involuntary conversions. So Zim owns an office building that he leases to a major department store. June 1st of 2018, the building is completely destroyed by fire. However, Zim has insurance, and the insurance pays him $1.2 million. Zim's adjusted basis in the building was $900,000 when the fire occurred. So Zim uses the insurance proceeds of $1.2 million, goes on a total shrooms bender in Las Vegas. What is Zim's realized and recognized gain or loss? Well, the amount he realizes is $1.2 million. That's the insurance proceeds he receives. His adjusted basis in the building when the fire occurred was $900,000. His realized gain is $300,000. His recognized gain is $300,000. And how much cash is in Zim's hands? $1.2 million, at least before he has to pay any taxes. So clearly, Zim is in a position to pay taxes on this gain. Let's compare that to Wubsy. Wubsy owns an office building and leases to a major department store. June 1st, 2018, it's completely destroyed by fire. Wubsy has insurance and pays him $1.2 million. Wubsy's basis is also $900,000. However, Wubsy takes the insurance proceeds, turns around and replaces that building with a new office building at a cost of $1.3 million. What is Wubsy's realized and recognized gain or loss? So the amount realized, $1.2 million, adjusted basis $900,000, realized gain is $300,000. If the recognized gain is $300,000, how is Wubsy going to pay that? Because he doesn't have any cash. He used all that cash to purchase a new building. And it's not like Wubsy wanted this. This was an involuntary conversion, right? So if he sets the fire himself, we got a whole different issue. But presuming this is an accidental fire, Wubsy didn't want it. This is an involuntary conversion. So Section 1033 comes along to save Wubsy. And it says, if property is compulsory or involuntarily converted into similar property, no gain shall be recognized. If, on the other hand, it's involuntarily converted into money, the gain shall be recognized. Okay, this is known as an involuntary conversion. And gain is deferred when appreciated property is involuntarily converted in an accident or some form of natural disaster. The basis of the property converted is carried over, so carryover basis. If it's an indirect conversion, then what that means is, someone got cash. The gain recognized is the lesser of the gain realized or the amount of reimbursement the taxpayer does not reinvest in qualified property. And in this case, qualified property must be of a similar or related use to the original property. So the rules for an involuntary conversion are very similar to a like-kind exchange. So in this case, it must be property similar or related in service or use to the properly so converted. And you have to put that through the functional use test. So the character of service or use must be the same for both properties. So recall, in a like-kind exchange, I could exchange a warehouse for a bowling alley. And I would apply like-kind treatment to that. However, under involuntary conversion, that would not be the case, because clearly a warehouse and a bowling alley do not serve the same function. When the property was rented, meaning when I'm renting it out, I'm the landlord, I own property, and I'm renting it to someone and it's destroyed, then the standard is relaxed as long as I replace it with another rental property of any kind, then I would treat that as an involuntary conversion. And if my real estate was condemned, now the rules are pretty much the same as like kind. So any realty for any realty will do. Okay, involuntary conversion is not mandatory. So unlike like kind exchange treatment, you are not required to defer your gains on an involuntary conversion. However, involuntary conversion treatment does not apply to losses. Any boot, or what we would call excess insurance proceeds, are treated the same as they would have been in a like-kind exchange. So again, involuntary conversions function under very much the same principles as a like-kind exchange. So let's go back and look at Wubsy. Remember, so Wubsy has this $1.2 million insurance payment. His adjusted basis was $900,000, and he turns around and builds a new office building for $1.3 million. So what is Wubsy's realized and recognized gain or loss? Okay, so the amount realized 1.2, adjusted basis 900,000. His realized gain is 300,000. However, when we examine his excess proceeds or boot, we can see that his proceeds are 1.2. He actually reinvested more than that. He reinvested an additional 100,000 of his own money, or 1.3 million. As a result, he received no boot, therefore no gain is recognized, and the entire gain of 300,000 is deferred. When we're calculating his basis in this new building, it is not 1.3 million. Instead, you calculate it as the fair market value of the new property minus any deferred gain. So 1.3 million minus 300,000 is $1 million. Okay, let's change the facts, but only slightly. So in this case, Wubsy's insurance pays 1.2, his adjusted basis is 900,000, but he only spends $1 million building his new office building. So in this instance, everything in the top three lines is identical. The amount realized 1.2, his adjusted basis is 900,000, his realized gain is 300,000. He receives proceeds of 1.2, he's only reinvested $1 million. Therefore, he has excess proceeds or boot of 200,000. As a result, he has to recognize his realized gain to the extent of that boot received. So 200,000 is going to be recognized. And when we think about calculating his basis in the new building, the fair market value is $1 million. The amount that is the gain that is deferred is 100,000. That's the 300,000 realized gain minus the 200,000 recognized gain. So $1 million minus 100,000 is a 900,000 basis in his new building. All right, one more. So in this case, everything's the same. Wubsy has the office building, but his insurance pays him only $800,000. He receives $1 million, or he spends $1 million on his new building. So what is his realized and recognized gain or loss? Well, in this case, the amount realized is $800,000. His adjusted basis is $900,000. His realized loss is $100,000. Recall that the involuntary conversion rules do not apply to a realized loss. As a result, barring any other unforeseen circumstances, he would recognize the 100,000 loss, and his basis becomes his adjusted basis in the old building plus any loss he recognized, or $1 million. Okay. So the last two non-recognition provisions come from what I would describe as a reasonable tax policy perspective, which is when you end up with cash in your pocket so that you can buy shrooms and go to Vegas, it's a pretty good bet you're going to pay the tax man. This one is a little less so. So once you purchase a home, for many, many taxpayers, you live in that home until you die or you downsize, right? So a lot of people will They'll often maybe buy a bigger home, but many of them will buy a first home and then they'll stay in it until they're done. So under the old rules pre-97, this is 1997, the gain on the home was deferred so long as you purchased a new home of equal or greater value. And then once you turned 55 years of age or older, you could exclude a portion of that. So the idea was very consistent with his ability to pay, right? So unlike when you sell stock, you often do not buy new stock. For most people, when you sold a home, you actually bought another home. And as long as you did so, and it was of equal or greater value, the idea was, well, you certainly didn't have any cash, right? So it feels a lot like a like-kind exchange. However, in 97, they changed the rule. And they said, look, at this point, we don't care what you do with the money. So the gain is excluded for a single taxpayer up to $250,000 or up to $500,000 if married filing jointly, as long as you were really, in air quotes, living in the house you're selling. So really living in the house means it was your principal residence. And that means you have to meet the ownership and use test, which means you have to have owned the property for at least 2 years, and you must have used that property for at least 2 years as your principal residence. There is no longer a requirement that you must buy a new home. However, you may not use this more than once in any 2-year period. Okay. So whether it's your principal residence or not is a facts and circumstances based test. And they would look at where do you spend most of your time, where do you work, where are your bank accounts, where's your voting registration, et cetera, et cetera, et cetera. So it's very similar to the residence test that we won't talk about that is related to state taxation. So 2 out of the last 5 does not necessarily mean the most recent 2. So, for example, Jim lived in his home for 15 years, but then he took a new job in a different state. But he simply wasn't ready to sell his home, so he rented it for a year, and then he sold it. So as long as Jim sells that house within 3 years of moving out, it still qualifies as his principal residence, because in the 5-year look-back window, he used it as his principal residence, and he owned it and used it for at least 2 of those years. So ownership means exactly that. He must have owned it, and he must have owned it for 2 years, right? Obviously, that does require you to have owned it up through the sale date, because if you sold it and then you sold it again, you didn't sell it the first time, because you can only sell something once. So Billy's a single taxpayer. He sells his home for $400,000. His adjusted basis was $100,000. If we assume he meets the principal residence tests for 2 years, then he could exclude $250,000 of his $300,000 gain. Therefore, he'd only recognize a $50,000 gain. Since he held it for more than a year and it's not a not capital asset, then he would treat that as a long-term capital gain. Billy and Mandy are a married couple, and they sell their home for $400,000. Their adjusted basis is $100,000. They both meet the ownership and use test, meaning they've been married and living in the same home for more than 2 years. As a result, they may exclude the entire gain because it is less than the $500,000 exclusion that is available to them. So there are exceptions. So let's say Billy is a single taxpayer. He sells his home for $400,000. His basis is $100,000, but he had only lived in the house for a year. And then his employer transferred him to a new job, so it really wasn't his fault. Normally, he would have been eligible for the $250,000 exclusion, but he doesn't meet the 2-year ownership or use test. So that's okay. There are exceptions that are made available for guys just like that. So exceptions related to a change in place of employment, health, or unforeseen circumstances. So change in employment requires you to move a minimum number of miles away from your former place of employment. So the idea is you can't be like, oh, I live in North San Diego. I got a job downtown, so now I want to move to South San Diego because the commute's better, which it's not, by the way. There's a set of tests that relate to being at least 50 miles away that you have to pass. This is more of, hey, I was living and working in San Diego and I got a new job in LA. Health is if for some reason you need to have someone take care of you. So this is far more common for a situation when you've been in the house, it hasn't quite been 2 years, and you fall deathly ill from some illness and require round-the-clock care. The tax code doesn't want to penalize you, so that meets one of the exceptions. Unforeseen circumstances is the biggest one, and of course there's no set principle, so what we have are a bunch of court cases or regulations. These are supposed to be events that you could not have reasonably anticipated before purchasing and occupying the residence. So, for example, acts of war, terrorism, someone's untimely death, unemployment, divorce or legal separation, or a multiple birth, right? So if suddenly you had, triplets and you had just bought a home and it really didn't have space for triplets, you were assuming you'd only have, one child, that's an unforeseen circumstance. So when that happens, let me back up a little bit. When that happens, what happens is you prorate the amount of the exclusion you're eligible for. So let's say that you had lived in the house for a year and you had a change in employment that qualifies as one of the exceptions. Well, then what would happen is rather than being able to exclude $250,000, you're only eligible to exclude $125,000. So you prorate the amount based on the portion of the 2 years you were there. All right. So with married taxpayers, either spouse needs to meet the 2-year ownership requirement, but both spouses need to meet the 2-year use requirement. So what that means is in order to get to the $500,000, both spouses need to have used that as their principal residence for 2 years. So what that is think about it as, let's say there's a couple and they get married. One of them has owned the house for 10 years. Now the other one moves in. They can't necessarily sell and get $500,000. They would only get $250,000 until they had lived in that house as a married couple for 2 years. Okay, so there are also some additional special rules. So one of them is you cannot exclude any gain caused by depreciation. So for example, if you've taken a home office deduction and not the safe harbor method, but the actual method where you included depreciation, to the extent you sell it and part of the gain stems from that depreciation, you are not allowed to exclude that gain. If you rented your home for part of the time, or you rented part of your home and you depreciated it, you may not exclude any of that gain under these rules. And then there's the 2009 rule, which relates to disqualified use. So let's assume that Mandy owns both a principal residence and a rental property. And Mandy's about to retire. And of course, so she sells her primary residence and excludes the gain. Then she realizes, well, let's see, I could either sell the rental and pay, long-term capital gains on it, or I could move into the rental for 2 years. And then in theory, exclude that gain also, except for, of course, the depreciation, which we just talked about. So in 2009, the Congress changed the rules and said that any use of the home after January 1st of 2009 as anything but the principal residence is considered disqualified use. And if it's disqualified use, then that portion of the use is not eligible for the exclusion of the gain. Okay. So what you need to do is you take the number of disqualified days over the total number of owned days, and you multiply that by the gain. That amount is not eligible for exclusion. So really the only way to do this is through example. So Jack Abel, a single taxpayer, bought a home January 1st, 2007 for $400,000. So he's renting it out for 4 years, and he claims $20,000 of depreciation over those 4 years. Therefore, his basis is reduced to $380,000. Then on January 1st of 2011, he converts the property to his principal residence. So then he lives in it for 2 years, right? The idea being now he wants to capture that and exclude the gain. So in fact he does. And on January 1st of 2013, he moves out and sells it for $700,000 a year later, right? So he moves out of the home. He's unable to sell it immediately But a year later, he is able to sell it. So as a result, he has a gain. So he sold it for $700,000. His basis is $380,000. He has a $320,000 gain. So ordinarily, we'd simply say, okay, well, he gets to exclude $250,000 of that, and the remaining $70,000 is long-term capital gain. However, he has disqualified use. So disqualified use is any rental use prior to the use as a principal residence, but after January 1st, 2009. So in this case, since he bought it January 7, all of 07 and all of 08 are fine. They're not disqualified use because they predate the law change on January 1st of 2009. However, starting January 1st, 2009 through 2011, when he moves in, that's disqualified use. So he's got 2 years of disqualified use. Then he lives in it as his principal residence for the 2-year period. And then that stub year at the end, that's 2013, right, when he moves out, but before he sells it, even if he rents it in that period, it is not considered disqualified use so long as it's within his 5-year window of measuring 2 out of 5 for the ownership and use test. Okay, so the first thing we would do is determine the amount of gain that it's possible to exclude. So the $320,000 gain is the total amount. He cannot exclude $20,000 because that's related to depreciation. So now he's down to $300,000. The disqualified portion of that is the 2 years of disqualified use over the 7 years of total ownership. Multiply that by the $300,000, you get $85,714. He must also recognize $85,714 then. As a result, the rest of it, the $300,000 minus the $85,714, that can be excluded. Since that is less than the $250,000, then he can exclude all of that amount. All right, that's an ugly one, but that brings us to the end of Module 11 and 12 videos. Thanks for watching.